All right, today we're going to open the vault on a topic that really touches every single part of our lives: money and banking. It's this incredibly complex system that powers our entire economy. So let's just dive right in and see how the whole thing works.
So, let's start by rewinding the clock a bit, back to 2008. You probably remember it. The whole world was just watching as this crisis, one that started with these super complex investments built from bundled up home loans, brought the entire global financial system to its knees. It started as this problem with American mortgages, but then it just spiraled into a full-blown global panic.
That's a huge question, right? How could something like that even happen? How could a problem in just one little corner of the market cause such a massive, widespread meltdown? Well, to figure that out, we've got to go back to basics. We need to understand how the system is even built, starting with its most fundamental piece.
Okay, so let's start there, with that most fundamental piece, money itself. We use it every single day, but what is it, really? Well, in economics, for something to actually be considered money, it turns out it has to do three very specific jobs.
Okay, so here they are, the three big functions. First, it's a medium of exchange. Super simple, right? It's what you use to buy stuff, saving us from having to, trade chickens for bread. Second, it has to be a unit of account. This just means it gives us a consistent way to price things and measure value. And third, it's got to be a store of value. That means you can hold on to it, and it should hold its purchasing power over time.
Okay, so this leads to a really common question, and it's a good one. When you go and tap your credit card to buy a coffee, it feels like you're using money, right? But are you? Really?
And the answer is a hard no. A credit card just doesn't meet that definition. Why? Because it isn't a store of value. Think about it. A credit card is really just a tool. It's a tool for taking out a pre-approved short-term loan from a bank. The real money, that only changes hands later when you actually pay your credit card bill.
So, since not everything that feels like money actually is money, economists needed a way to measure how much of it is really out there. And they've created some very specific ways to do that. Let's take a look at the two most common ways they count it all up.
All right, these measures are called M1 and M2. The easiest way to think about M1 is that it's the most liquid money. Liquid just means it's super easy to spend right now. So we're talking about physical cash, the bills in your wallet, and all the money in your checking account. Then you've got M2. M2 is a much broader category. It includes everything in M1, plus money that's a little bit harder to get to, like the cash in your savings account. And trust me, the Federal Reserve watches these numbers like a hawk, because a sudden change can signal big shifts in the economy, or even the risk of inflation.
Okay, now here's where it gets really fascinating. If you break down the total money supply, you see something wild. That M1 money, the cash and checking deposits we use every day, that's only about 23% of the total. The vast majority, more than 60%, is just sitting in savings deposits. What that really shows you is that most of our money, it isn't physical currency at all. It's just digital ones and zeros in a bank's computer system.
So, who is the one managing all this money? Who oversees all the banks? Well, in the United States, that enormous responsibility falls to one single institution, the Federal Reserve. You've probably heard of it as the Fed.
The Fed has a pretty unique structure. So at the very top, you've got the Board of Governors. They're based in Washington, D.C., and they're the ones providing the main oversight. But then, supporting them, you have 12 regional Federal Reserve banks scattered all across the country. And the group you always hear about in the news, the one making those huge decisions about interest rates, that's the Federal Open Market Committee, or the FOMC.
And what does the Fed do? Well, its job is massive. First, it controls the nation's money supply. It also supervises and regulates the entire banking industry to make sure it's stable. It's the institution that actually issues the paper money we use. And maybe most importantly, it acts as the lender of last resort. This is so crucial. It means it provides emergency loans to banks to stop them from failing and to prevent financial panics.
And you can see from this map of the 12 districts, the Fed really does have a presence all over the country. And this design is totally intentional. It makes the Fed a decentralized central bank, so it's not just some single entity stuck in Washington. It's also what they call quasi-public. Now, what that means is that it's an independent government agency, but the regional banks are actually owned by the private commercial banks in their own districts. It's this really unique public-private hybrid.
Okay, so we've talked about what money is, how we measure it, and who manages it. But all of this, it leads to what might be the most important question of all. What actually gives any of this money its value?
For a long time, the US dollar was backed by gold. You could literally, in theory, walk up and exchange your dollars for a fixed amount of gold. But that hasn't been true for decades now. So,
If there's no pile of gold in a vault somewhere backing it up, what makes that dollar bill in your wallet worth anything at all?
Well, when you boil it all down, the value of our money comes down to one thing: faith. It's just a collective belief system. Think about it. You accept a $20 bill when you sell a pizza, not because you value the piece of paper, but because you are absolutely confident that someone else will accept that same bill from you for something they value. The entire system, it's all built on trust.
And that brings us full circle, right back to 2008. Because back then, it wasn't just about trust in dollar bills. It was about trust in these incredibly complex financial products. You see, the crisis was fueled by a process called securitization. This is where banks took thousands and thousands of individual mortgages, bundled them all together into new investments, and then sold them to other institutions all over the world.
And for a while, everyone had total confidence in these investments. But then homeowners started defaulting on their loans. Not just a few, but in huge numbers. And just like that, the confidence, it shattered. All of a sudden, nobody knew what these complicated securities were actually worth. Trust between the banks just evaporated. And the flow of credit, the very thing that keeps our economy moving, it just froze solid.
And really, this is the core lesson. From the single dollar bill in your pocket to the most complicated financial instruments on Wall Street, our entire financial system is built on this foundation of trust. The 2008 crisis was just a brutal, painful reminder of how quickly everything can unravel when that trust is lost. So it leaves us with this one crucial question. In a system this complex, how do we make sure that trust is never broken again?